Well, hi everyone, and welcome to the Buffett and Beyond Research Weekly Video Stock Analysis. And these methodologies are based on the book Buffett and Beyond, second edition, published by Wiley Publishing. And this week we're going over Apple Computer, and it's up 47% in the past 2 years. And considering that the market's not doing anything this year, that's a pretty good sign right there. And we always want you to remember that if you want to walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's go over Apple. We all know what it is. And one of the favorite sayings that Warren Buffett has is that people would rather sell their second car than get rid of their iPhone. Well, it was established in 1977, which is something I really didn't know, and one of the world's largest makers of PCs and peripheral and consumer products, such as the iPhone smartphone, Apple Watch, iPad tablet, and its Mac line of personal computers. Then down here, it also sells operating system services like iCloud storage, which is getting very, very popular now, and Apple Pay, and a host of digital content from popular iTunes, and as well as other portals, and has approximately 166,000 employees, and that's been pretty steady over the past couple of years. And let's look at Apple, and these are 5-year averages. Green is Apple, and maybe we should have put it in red, but green is Apple. The average stock, the average large cap stock out there is in blue. So when we look at the clean surplus return on equity, and we look at this as a bank account, would you rather put money in your bank account that's earning 13.5% or one that's earning 20.7%? So yeah, there's no contest there. So it's got a higher clean surplus ROE over 5 years, but we're going to show you something in the next slide that might spoil things just a little bit. Net income, the average stock has about a 13% 5-year average of net income. Now, what is net income? It is the clean surplus earnings. So you take the earnings of the core operations of the company and take away non-recurring items and future liabilities and maybe some of those stock options that management has been promised to be part of their pay package. Yeah, little things like that. So it's falling behind in net income, but revenue averaging 9% over the past 5 years, higher than the average stock of 7.1%. So let's look at these numbers a little closer. First of all, these numbers over here, net income, this 825 has just gone up from $7.85, and the 2025 numbers have been raised from a little over $7 to $7.46. So yeah, these numbers have gone up, a little surprise to the upside. But we want to bring your attention to this ROE. Look how nice and high and steady it was, and now little by little it's starting to come down. And we've seen this before, but in 2025, this past year, it still got up to 19.3%. Now remember, the average stock has a 13% clean surplus ROE, and we like to see a 20% to be in our growth portfolio. But boy, how can you sell Apple as long as these numbers stay strong in here like this? Retention rate, we want to bring your attention to that. It's still taking 85% of what it makes to put it back into itself in order to grow. And with this AI coming along, that's got its pie. I was going to say it's got its finger in the apple pie too. And so we'll see what happens there. And here's the net income. Even though it's below the 13% of the average stock, and the 5-year average is 8.3%, for 2026 they expect it to go up to 10.6%. And then the revenue growth averages 9%, but for this coming year, or for this year that we're in, I should say, up 18.4%. That's 2.5 to almost 3 times that of the average stock. So what this stock keeps doing is it's such a big company, but boy, it keeps putting out that Apple iPhone and just keeps coming out with things that people want and people feel they need, especially the phone. There were other companies that had their chances to come in and compete with Apple, but Apple has it all over the other folks out there. So it's still a great company, folks. And years to pay debt, This is Buffett's rule of thumb. He says if a company takes all the money it's making and uses it to pay off the debt, how many years would it take to pay off debt? His rule of thumb is 5 years or less. Our rule of thumb is 3 years or less. And folks, this company can pay off its debt in 6-7 months. So we don't have to worry about the debt. And if interest rates go up, we don't have to worry about them using some of this money they're reinvesting back into themselves in order to pay the interest on the debt, because there's hardly any debt there at all. So yeah, Apple is still chugging along, doing very, very well, folks. And in the last 12 months, black line is the S&P 500, and the blue line is Apple. And you can see it was lagging Apple for the first 6 months of these past 12 months, and then all of a sudden it shot ahead, and right around now it's just about even with the S&P 500. And over the past 12 months we were looking at a 19% return from both the S&P and Apple, so we kind of like that. It's hanging right in there and doing very, very well, and people consider it a safe company. And that's the important thing about a stock like Apple. It doesn't do just one thing. It's not a one-trick pony, as they call it. It's got a lot of things at its disposal that it can sell, and therefore that makes it a safer company. And it's got a moat built around it because of that iPhone. And as Buffett says, people would rather give up their second car than give up their iPhone. And the past 5 years, black line again is the S&P 500, and we can see that over the past 5 years, Apple has really outperformed, with the market up about 70%, and Apple up about 115%. So yeah, it's doing well over the longer run. And look at this run that it just had recently. Coming into the new year, 2026, it really shot up because the numbers came out that were surprising for the third quarter. So this in here is the fourth quarter, but the numbers came out from the third quarter, and the market liked what it saw. So brought it right back up here, folks. Looking very nice indeed. So remember, folks, our goal, build your wealth faster and safer with better than average stocks, and Apple is certainly a better than average stock. And yes, Apple is in our portfolio. So folks, remember, you go out this week. We've had a tough first 2.5 months of this year, and we're having a tough past couple of weeks with the war going on, an oil shortage, or maybe not an oil shortage, and the news changes every 5 minutes. So the thing is, go out, get your mind off the market, get a friend who's got a sailboat and go out and watch that sunrise. And if you're on the other coast, watch the sunset, folks. So you take it easy, be with your family, most of all, stay safe, stay well, and we'll see you back here in a couple of days.